this.
Okay, good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, joined as always by my good friend and colleague Todd Anderson. How are you doing today, Todd?
I'm well, Peter. Just trying to keep up with the event. Only a few short weeks away.
Yes, less than 3 weeks now. We are in crazy mode over here at Fintech Nexus. Joining us for the first time this year, we have the very deeply respected Dan Kwan of Nevcot Ventures. How are you doing, Dan?
Doing great. Thank you, Peter. And thank you, Todd, for inviting me back.
Of course. Always great to have you.
Indeed. Well, let's get into it. We've got lots to cover today. Another busy week in fintech news. We're going to kick it off with Apple. Apple launched their new savings account this week, and it's a high yield savings account, 4.15, not the highest rate in the country, but not that far off it for a savings account. So a really very competitive interest rate. You can open it up in just a few clicks on the app, but I don't know about you guys, but I don't actually have access to it. I tried. It's not available to every Apple user yet. So
I haven't tried yet, so I'm not sure.
I don't have access. So anyway, it's okay, but it is.
Still have a Marcus account.
Sorry,
I still have a Goldman Marcus account.
Oh, you do? I wonder if that gives you any special privileges. But anyway, it's a big deal because Apple just continue to do more in fintech, and they seem to, when they execute, they're executing well. And this, when I saw some screenshots and the user experience that people shared, and it is like 3 or 4 clicks and you are done opening up the savings account. So it's really a slick process. So anyway, Todd, what are your thoughts?
Yeah, I mean, if regional banks weren't nervous already with what's been going on in the market, seeing Apple launch a savings account that makes it that easy to open, it'd make me a little bit more nervous.
Mm-hmm.
Now, I don't know how much of as we've talked about many times the last few weeks, how much of the money is and customers are really leaving these banks yet. But, the more Apple gets ingrained in financial services, the harder it is for someone that uses an Apple device to go elsewhere. Like, they just make it so simple to open an Apple card, open an Apple savings account, purchase it with Apple Buy Now, Pay Later. I mean, it makes it so seamless that it's like, yeah, why am I going to go to X bank around the corner? Or why am I going to go online and fill out all these documents? I mean, Apple has everything already. Just click, open. So it would make me nervous. And eventually, I think the Congress and the regulators are going to have a hard look at kind of how far do they want Apple to go before they put them under the microscope and say, hey, you need to spin off and create like Apple Bank or Apple Financing or whatever you want to call it. Because eventually they probably will.
Yeah. What do you think, Dad?
Well, I think, Todd, the last thing you said was really, really powerful. I think this news, obviously, we're probably going to, in the next piece, we're going to talk about Goldman's, another business. So what does this say about Apple? What does this say about Goldman? Right? Goldman clearly is trying to, their Marcus account is only 3.9 APY, and this is 4.15. And the question for me, should I switch from Goldman to Apple? Right? It should be a no-brainer if the process is so slick, so easy. I can get another 20 bits higher on my savings account. But this also really says a lot about Apple. They're paying for their Buy Now, Pay Later. The underwriting is being done in-house, now sort of the traditional outsource to a bank. And Goldman basically offers them a license. That's all they get, right? That's all it does. So it's just, so this is really an Apple product. This is different from Apple Card. So I think it's really gonna, now they're getting to savings, maybe checking is the next step. So they're gonna really provide a full-fledged financial services to anyone who uses the Apple device. And as Paul said, there's no reason for them to get out. So I think there's going to be a lot of questions for Congress and for regulators to really, to think about.
Yeah, it really will be, particularly when they get that checking account. But it is, the thing about it, It just works so seamlessly. It's so integrated. Goldman is like, I mean, it's mentioned in the fine print, but this is Apple. It's not Apple and Goldman. It's Goldman in the background. And anyway, we need to move on and talk about Goldman Sachs, because they did release their first quarter earnings this week, and it they did okay, but not as well as many analysts expected. Revenue was down, and they had people sort of looked at, like, the whole fixed income area was down. They did much worse than the other big banks in that area. Normally, as Goldman's a leader there. But the thing that was interesting is they announced they sold $1 billion of Marcus loans. And a lot of people said they took a $470 million hit on that, which is not true. They released $440 million of expected losses and took a $470 million hit. So that's $30 million of net negative on the $1 billion of Marcus loans. But all of Marcus loan portfolio, the whole portfolio was up for sale right now. And the other thing that's up for sale, Green Sky, that they just bought a year ago. So that's real interesting developments out of Goldman this week.
What's funny is, you were talking, Peter, I actually set up an Apple savings account in 50 seconds.
50 seconds
on this call. 50 seconds.
That's live TV, folks. Todd is working it.
But that's how seamless that account is. That in literally less than a minute, as you and Dan were talking, I was able to set up a savings account. Onto Goldman. I mean, it's just the continuing move away from being on the front side of the consumer business. I think in our news call this morning that we chat every morning, I talk, Goldman's kind of going back to being the Wizard of Oz, which is the firm behind the curtain. They're the ones behind the big transactions on Wall Street. They're the ones behind some of the Apple, financing and card stuff. And that's what they're good at. They're good at that type of diligence and that type of work. They clearly made a big bet, and they made the wrong bet, probably at the wrong time, because it kind of fell into this weird scenario where we are today. But I think part of it was really semantics and PR, in that David Solomon talked about this move so publicly. When you look at their entire balance sheet and everything, it's not that big of a portion of their business, but he talked about it so much, it gives the impression that they did, half of their business wasn't consumer, when the realities were different. But he made a big bet, and they're exiting from that bet.
Yeah, but honestly, I have always been puzzled by Goldman's decision to get into consumer banking, because at the end of the day, Wall Street and Main Street are two different kinds of businesses. I mean, maybe JP Morgan probably is one of the few that actually has been able to master both trades, right? So they're big on Wall Street, but they're also, biggest lender, biggest bank, consumer bank in the country. Citi maybe be another one. But Goldman really, as Tom mentioned, has been really the sort of the Oz behind the curtains. They're good at, their specialty is M&A, investment banking, wealth management, trading. And I think when they launched Marcus, this was 6-7 years ago, maybe longer than that.
Yeah, 2016 it was, yeah.
Yeah, I think there was a lot of hope that, this is a bank without any legacy infrastructure. They can build a true digital bank that can really compete, head to head with the fintechs. But obviously, that was, unfortunately, is not successful. And obviously, other banks, think about Finn from JP Morgan Chase. That was also, and what's the other one? Greenhouse from Wells Fargo.
Yeah.
Now, initiatives end up being successful. They have to be pulled.
Right. Yeah, that's.
I wonder how much of Goldman it was like. The everyday consumer doesn't view Goldman as like, hey, that bank on the corner. They view Goldman as like the boogeyman on Wall Street in a way. And
that's why they had the Marcus brand. The Marcus brand,
but still, it said Marcus by Goldman Sachs. Yeah. I mean, did that play into like, I'm not going to give my money to these guys. I mean, these are the gamblers of Wall Street. I don't know how much that played into it, but it felt like the everyday person didn't connect to Goldman like they would some of these other regular bank brands.
Anyway, we need to move on.
Yep.
We have got several crypto regulatory articles here we want to cover. First is stablecoin. It's a draft stablecoin bill was put out last Friday night, was released. And it's basically putting together a framework for stablecoin regulation, and it's a draft bill, and it was discussed in the hearing that came on Tuesday with the House Financial Services Committee and one of their subcommittees actually, and it basically talks about how there's no algorithmic stable coins. We want to have US issued stable coins. It was a big win for Circle. A lot of people thought it was, Circle's kind of was one of the co-authors of the bill, but it's still got a long way to go before it goes anywhere. But at least this is the first foray in 2023 into actually having some kind of crypto bill coming to at least a draft form.
Well, I mean, yes, that's probably a positive note for sure. But at the same time, there's literally no support from the minority, and I think the kind of camaraderie that McHenry and Waters enjoyed last year when they co-sponsored that stablecoin bill, which unfortunately was basically died a natural death after the FTX blow up.
Right.
I think I read something on Twitter today, and somebody was posting that if anyone tells you that we're going to have a stablecoin bill, that person is lying to you. There's no way Congress is going to really, the members of Congress, different two parties, and even members within each party will reconcile their differences. And I think one thing I want to point out in this bill is that I think this bill, obviously this is the McHenry Republican version of the stablecoin. They really wanted states to take a lead role in regulating stablecoins versus the federal agencies. I think that's something I feel like is sort of a red line for the Democrats.
Yep.
I just feel like right now the environment for any regulatory, legitimate regulatory reasonable action is just so toxic right now.
Yeah.
And I mean, we saw the news about Coinbase opening up in I think it was Bermuda or the Bahamas, but there's just such a toxic nature right now between not only the legislators themselves, but also between crypto and regulators and legislators. There's just this circle of players that are all very toxic with one another right now. And I fear we're going to look ahead 3-4 years with little being done. And all of a sudden, Europe's going to be X far ahead of us, and other areas will be X far ahead of us when it comes to crypto related, financial services that we're going to try to catch up really quickly. And then something's going to get screwed up with that, trying to catch up quickly. So I feel like we're just putting ourselves way behind the 8 ball.
Yeah, and speaking of toxicity, we had Gary Gensler speak. He testified before the House Financial Services Committee. We had Chairman McHenry grilling him. There was a really pretty famous, now famous interview where he asked Gary Gensler whether ETH was a security, and Gary Gensler would not answer. The thing that frustrates me is that Gensler says crypto, like the legislation the existing legislation is clear, and yet he won't answer whether ETH is a security. I just don't get it.
If it's clear, he has to have an answer on that question.
Yeah.
If it's unclear, then okay, then it's we need to write new rules or whatever. But saying it's clear and then not answering is the antithesis of saying it's clear.
Yeah, it's hypocritical if nothing else.
Yeah, I mean, so another interesting exchange between McHenry and Gensler was when McHenry said, "How can something be both a commodity and a security? And which agency is going to really regulate that?" And Gensler first gave a very theoretical response, and he ultimately said, "Yes, it cannot be both at the same time." Yeah, I think I think we should actually really learn a lesson from the FTX blow up, right? So this is a company that was really domiciled outside the US and without proper supervision, regulation, oversight, and nobody really checked what they were doing, and the things just became from bad to worse. And a regulation by enforcement is really not the best way to really move forward if we believe crypto has the future for financial services.
I think that's part of it. Is that a good chunk of the regulators don't think it has a future, and we just got we got a couple of comments here. In
it's actually
it's actually one comment,
really one comment.
One comment from our illustrious leader Bo Bruskern chiming in that the ugliness on Capitol Hill is not good for the future of financial innovation. There we go. Okay, so let's move on to an area of the world that seems to have their act together a little bit more, and that is the EU. They just approved today this MiCA legislation. That's Markets in Crypto Assets, MiCA. It's been sort of around for a couple of years now. It was approved today. I mean, very strong majority approval, and it's going to be implemented over starting in July of 2024. The requirements will be kind of implemented progressively, and it doesn't do everything. There doesn't sort of do anything with DeFi. Wouldn't have prevented some of the blowups that happened last year, but it's clear, it's law now, and it's putting Europe as really a leader here in crypto regulation.
I know Dan will probably have a better analysis of the actual legislation, but when did we get to the point of everything needs to be perfectly lined up and clear, and every scenario needs to be that's not how it works. Legislation and regulation, and then things are iterated. There's comment periods, and you learn and you continue to evolve. It feels like we're just trying to come up with this perfect bill or perfect legislation. That's why I applaud what they did in Europe, and how big of a consensus they had was, let's put something on the books. Here's the starting point. Yeah, some things weren't addressed, but there's bad actors in regular financial services that still happen. I mean, not everything's going to be perfect.
Yeah, I mean, so I think I think at least Waters and McHenry, they took the right approach last year when they tried to tackle stablecoins, right? Which is really low-hanging fruit compared to DeFi and NFT and other issues such as are tokens really securities, right? So these are much harder issues to tackle, but they really try to tackle a low-hanging fruit. But I think it's just, unfortunately, we have a very toxic political environment in Washington, D.C., and nothing really can get done. And not to mention, next year is the election year. I do not expect anything to happen between now and the next year, not to mention just the animosity or disagreements between the two parties. I do think, if MiCA was in place, last year, I think the FTX kind of blow up probably would not happen, because then these entities will have to register with, I don't remember whether it's ESMA or EBA, but one of those two entities are going to be the regulators, supervisors of the exchanges. And the same thing will happen in the States as well. If we had such a regulatory framework, whether it's state or federal, then these exchanges will have a proper oversight. Instead of now we have literally just a cup or maybe two cups on the beat and trying to go after companies that are operating in the space. And some of them are fraudsters. They deserve to be shut down. But a lot of things are just, as Gensler said, the law is clear. The law is not clear.
Right. And so this is prompting our next story, which Todd touched on. Coinbase, the CEO of Coinbase, Brian Armstrong, was at the Innovate Finance Global Summit this week, happening in London, and he spoke there, and he said nothing's off the table when it comes to potentially relocating Coinbase, and the fact that the EU now has a good framework in place, that is something that might be pretty attractive. But anyway, they announced this week they are expanding to Bermuda. which is actually I don't know, it's a UK territory or something. I don't know exactly the governance of this island nation, but anyway, they passed digital assets regulation in 2018 in Bermuda, and so Coinbase wants to start a derivatives exchange. So they're going to be starting up some kind of operation in Bermuda in the near future.
I mean, just hearing him say where nothing is off the table about moving a U.S. founded company elsewhere because the U.S. regulatory environment is so toxic and negative towards this type of company that he's like, all right, we'll just get up and move, which today is a lot easier than it used to be for anything. But to a point Dan made earlier, how many of I know the critics will say, well, this blow up would have happened or this blow up, but how many things would have happened had everything been brought under even regular US banking rules in some cases where they had to register, they'd have to be certain requirements, AML, KYC, all this stuff. Would we have stopped some of what we saw just because they wouldn't probably have taken these risks in the first place out in out of the US? They were like, hey, we can kind of fly by the seat of our pants. Let's take these risks. Investors are flooding us with money. Let's go. Here, they wouldn't have been willing to take as much risk. And therefore, I think it would have led to a lot less turmoil than we saw in the crypto markets.
Yeah, I think the policymakers here are probably taking the sort of not in my backyard approach, right? So as long as it's not in the banking, so this we ring fence this, so it does not really affect banking. But hey, we had SVB. SVB doesn't do anything crypto. SVB still failed, so and required a government bailout. We haven't seen any crypto that really required a government bailout, right? And I'm not really defending FTX or these sort of bad apples, but what I'm saying here is really, if you really want to be serious about regulating crypto, you need to bring them under your authority. You cannot just say you cannot do banking and we're going to shut you out of the banking system and we don't like you, so you should go offshore. Offshore is not a solution, especially if so many Americans are using crypto services, products, and so and
right. We have another comment here from our fearless leader. If the idea of causing Coinbase to move off US soil doesn't infuriate you.
Assuming you're a US citizen.
Strong words there from the Fintech Nexus CEO. Yeah.
Who is that guy?
Anyway, moving on. I want to go to your former employer, Dan, the CFPB. We found out this week there has been a data breach there. 256,000 records, consumer records, were sent to a personal email address by a former employee. He's no longer an employee at the CFPB. Also took supervisory information on 45 institutions. This all happened. It was became aware on February 14th, and the Bureau apparently followed guidelines and they went off to the Office of the Inspector General, I think it was. But anyway, this is not a good look for the CFPB. Dan, what are your thoughts?
I mean, this is definitely a big black eye for the CFPB, which has been, the champion for consumers, so they speak, and I believe so too. But I think this is, obviously this is just one employee, former employee, one bad apple did something bad. I'm sure, and I'm 100% sure that there is policy and procedures in place and the proper trainings in place that employees should who have access to confidential information should treat the information diligently, prudently, and the employee obviously did not follow the instructions that he or she received. But this really is a big problem. So I remember this was almost 2 years ago, maybe a year and a half ago, when I testified before the House Financial Services Committee on the issue of the CFPB creating a credit reporting bureau to replace the big CRAs, Experian, TU, and Equifax. And one of the things I remember, then Ranking Member McHenry asked me about cyber attacks and also rogue employees potentially leaking information, getting the consumer PI information in the wrong hands. And thinking about this, right? So if the CPU was actually doing all the stuff, and luckily so far, I mean, we don't know all the facts. That looks like this leak is not going to really create any kind of identity thefts or unauthorized transactions. But in a different scenario where the bureau has all the records of consumers,
right,
and the records actually got into the wrong hands, I think that's going to be a much bigger issue. And what if there's a class action lawsuit? Who's going to really pay for the legal bills? Who's going to make the customers whole? It's ultimately taxpayers.
right.
I mean, I think a lot of companies and other agencies are looking like, how do we allow access to certain information, and what's tokenized and what's not, and how real time is, like, changing codes and all this stuff. I mean, there's a lot of companies that implement, a lot of friction for employees to look at certain information. I'm sure they're trying to think, like, how much more barriers we put in place, because it shouldn't be allowed, or that information shouldn't be able to be downloadable, maybe should be the better term, to then email it to yourself. So I think it's just going to be a lot of companies looking inward and saying, what are our protections on certain data, and how can we increase those protections? And for the Consumer Protection Bureau, it certainly is a black eye, as Dan said.
Right. Anyway, moving on. I want to talk about a fundraise, successful Series A fundraise that was announced this week. Clerky, Clerkie, company I didn't really know at all until I did some research on them this week. $33 million Series A. That's a good Series A for 2023. Let me tell you.
Oh yeah,
big names: Flourish, City Ventures, CMFG Ventures, Wellington. David Velez, the CEO of Newbank, invested. Founder of Intuit invested. Really an impressive company. Like, it seems like this company has a B2B offering and a consumer offering. I went to the App Store, and the Apple App Store, it's 4.9 stars. So it's all about debt repayment. So it's got, like, helps consumers manage their debt. Looks like provides some kind of debt consolidation. But more than that, also helping them on advice and that sort of thing. And then has a tool for lenders as well. Really, really interesting company.
And it tells me that the investors are looking at this company saying, what's coming around the corner, which is a lot of consumer debt that is going to need help either being consolidated, or help paid off, or help understanding what people's options are. Because as we enter into a recession, or whatever you want to call it, downturn, that's when people will have issues repaying their debts. And I think that's the bet they're making with seeing how big this Series A was.
Mm-hmm.
Yeah, I mean, this is absolutely a great raise. I mean, I haven't seen any numbers in terms of valuation disclosed, but I assume probably, including $33 million, the post-money probably is around $200 million, which for a 5-year-old company, that's a pretty impressive story, especially in today's very soft fundraising environment. And I have to say, this is a very tough space for anyone to really operate in, right? So it's a stock consolidation. You're dealing with really consumers in trouble, and anything you do, you've got to be extremely careful, because regulations are in place to protect such consumers. And I know nothing about this company, and I also, just like Peter, what you did, I look at their website, and not sure about their consumer product, but their B2B product sounds very interesting. They're using AI and the machine learning to really identify consumers who may get into trouble, may get into default or delinquency, and really help alert a company lender and help them to proactively address. If that's really what they do, I think this one has a lot of potential.
Mm-hmm. Okay, well, we're out of time. There's one more story I wanted to talk about. I'm just going to mention it briefly. Owners Bank is a new small business focused digital only bank launched this week by Liberty bank. Looks really interesting. So check that out. But we are out of time. Todd, always great to have you on. Dan, thank you so much. Great to have you back. And just a reminder, we are now less than 3 weeks away to the most important fintech show of the year, Fintech Nexus USA, happening in New York City. It's May 10th and 11th. Tickets are available. Price break ends tomorrow. The last chance to get discounted tickets is before Friday night. That's what's the date today? It is the 20th. So 21st of April is your last chance to get a discounted ticket. Okay. With that, I'll wish you all a good afternoon, a good evening. Thank you very much for watching or listening. And we'll be back 5 p.m. Eastern time next week. Thanks, everybody. See ya.
See ya.